A very good morning to everyone participating in this workshop. This is the first time I'm doing this presentation online. Please bear with me. Let me briefly introduce myself. I was the former CEOs and executive directors of several stockbroking companies in Malaysia before my retirement in May 2019. Currently, I'm starting out my own investment training academy, namely Bull Traders Trading Academy, having an office at Sunway Joe, Bandar Sunway, Selangor. Before we start, I would like to thank the event organizer for inviting me to speak on this interesting topic on smart investing. We all know that there are losers and winners in any financial markets. The question is how to win and be a smart investor. Before we proceed, let me read to you the usual disclaimer statements. Please note that the materials and the various quotes presented in this seminar workshop is intended solely for educational and illustration purposes. The views and opinions presented by me do not constitute any forms of legal or financial advice. You should consult your professional advisors who are more familiar with your investment needs and other matters before making a decision to invest. Okay, the topics we're going to cover today are why invest in stocks. Two major investing approach commonly adopted by traders and investors. That is value investing and short-term trading. We also try to understand the risk characteristics of the six main groupings of the stocks listed in Bursa Malaysia. We'll go through briefly reviews of the 6 key fundamental analysis factors for value investing. It is good also to know the reason why most people lose money in stock investment and trading, and how to be a smart investor. So I will introduce a more systematic approach to investment and trading, which are developed by me, known as the Bull Traders Systematic Approach, or BTS in short. This BTS, just bear in mind, it's not the recent hot Korean groups. This is Bull Traders Systematic Approach to investment. Lastly, I'll briefly share with you the BTS 5 useful technical considerations for traders. I hope with that you have a fruitful day. All right. Why invest in the stocks? The first thing most people think of is making money from the stock market, right? But in reality, according to past studies, more than 80% of the stock market participants lose money. Only about less than 20% are making money in the stock market. These are the smart investors. I hope after my presentation, a lot of us will become informed investors or traders, making stock market your lifetime ATM. Whenever you need money, just go to the stock market and then get some money. That would be nice, right? Okay. Why invest in stocks? Stocks are the best asset class to invest over a long term. And according to Professor Jeremy Siegel, over a period of 20 years, a portfolio of diversified stocks has better returns than a portfolio of long-term government bonds. Several other investment gurus like Warren Buffett and Peter Lynch have been also delivering excellent double-digit performance over a longer period of more than 10 years. So besides offering better chance of high return, stock can also generate good passive incomes with regular dividend and appreciation of price over time. Stock is a good asset class for diversification of investment portfolio risk, besides investing in real estates, currencies, commodities like precious metal, gold, silver, platinum, and so forth. So stock is also a good hedge against inflation. Yeah. As you can see, inflation in Malaysia used to be about 2.5 to 3.5%, but today it should be going below 2%, yeah, because of the COVID pandemic that has affected the economic growth of the world economy as well, not just Malaysia. Okay, FDR is only earning about 2.5 to about 4% previously. Now it's even less than 2%. Bond treasury is in the region about 2.5 and 6% as well. Okay, there are two major investing approaches that most people are practicing. The first one is value investing through extensive use of fundamental analysis to determine the intrinsic values of a stock and to buy at a discount. The focus is on valuation and dividend-paying stocks with a long-term holding. The Warren Buffett way of investing is aiming to buy at the discounts of 20% margin of safety. The second approach is trading through the application of technical analysis tools and price volume action to time the entry and exit of a position for short-term profit. John Maynard Keynes opined to professional investors to devote to analyzing how the crowd of investors is likely to behave in the future, the mass psychology, and how during periods of optimism they tend to build their hopes into castles in the air. The expectation. So Professor John believed that it is a perceived value that is driving the stock prices. So what is fundamental analysis? It's a study of the financial performance of a company to determine if a business is profitable, growing, and with healthy cash flow and quality assets. All right, it involves several processes, analysis, sub-analysis. The first one will be on the review quarterly performance of the company, key financial ratios and valuation to give an idea of earnings growth and so overall the performance, financial performance of the company. This covers the reviews of the quarterly results as announced by companies, under the Bursa listing rules. All these companies are required to report their quarterly results within 2 months after the closing of the quarter. So if fundamental analysis also involve reviews of major changes in top management team, all right. It's important because a skillful and professional management brings growth and value to a company. The review also includes impacts of major macroeconomics and political developments on the business, especially those trading with overseas partners or customers, which are more susceptible to currency fluctuation. And it also involves the follow-throughs of the latest news and business developments of the company and industry. News on profit accrediting contracts, winning of new contracts and so forth, expansion of business, new products, launch, capital restructuring, corporate actions, new competitions or new laws affecting the industry. So that is fundamental analysis. What about technical analysis? What is technical analysis? It's a study of the investor's emotion. Technical analysis is one of the methods to predict future price movement through the studies of the past historical data, price and volume. TA, in short, is the art of identifying crowd behavior or mass psychology mentioned just now, in order to join the crowd and to take advantage of its momentum. All right. So let's look at the components of this technical analysis. The first one is trend analysis. All right. So second is candlestick chart patterns. Third is technical indicators. Fourth is price volume analysis. Fifth is chart patterns. And number 6 is momentum indicators. So with the studies of all these components of the analysis, it gives you a picture of the potential price movement of the companies. Of the 933 stocks listed in the Bursa Malaysia today, they can be grouped into Six main categories exhibiting varying degrees of risk exposure and volatility. To make money in stock investment, it's important to ensure that the risk of the stocks we select matches the risk tolerance of the capital, and also the risk and volatility of the stock must be in sync with our risk appetite, so that we can remain rational and cool in handling the stock, what do you call it, volatility. So briefly, the six main categories of stocks are listed here, as shown in a slide. The first one is the investment grades. These are involving companies with more than 10 years of good profit records. Generally, all the FVM CI's 30 stocks are in this investment grades category. The second is the emerging grade growth stocks. These are fast-growing companies like in those in the semicons and the IT sectors. And the third grade are the cyclical grades. Those are companies that where the sales are depending very much on seasons of the year, like hypermarkets, fashion, etc. The fourth category is turnaround categories. These are companies during undertaking corporate restructuring or new capital injection, trying to revive the business or finding new business to venture into. Sunset or failing companies. These are companies, unfortunately, the products become obsolete or made redundant by new innovations and technological changes. It could also be caused by the change of consumers' behavior and preferences. The last is the startup, or these are new small capitalized companies without profit records, most of them. All right. So you can see that the risk of these six categories of stocks are ranging from the low at the investment grade to the higher risk at startups and those sunset or failing companies. Just to note that most of the turnarounds, so-called restructuring companies, companies asking for new money to rights issues to revive the business, in most cases, I think 80% of them, safe to say, are not able to turn around. So you got to be careful when you are dealing with these, putting money in these companies. How to value a company? More applicable for value investing, those who are trying to identify the intrinsic value of stocks with its growth potential. So there are a few financial considerations that we should be looking at. Among the most commonly approached are the discounted cash flows approach to derive an enterprise value of the company, or fair value, and also the PE valuation model, which are extended to include PEG and dynamic PE, discounting PE by profit growth rate. And most people also use price to book for or NTA to in consideration for the merger and acquisitions process. So what are we looking for in evaluating the fundamentals of financial performance of a company? The six key financial fundamental analysis factors are listed here. First is the nature of business. You understand the nature of business. That means what we are looking at is that what is this company is doing, and risk exposure to forex and also interest rate and the barrier of entry. It's important to know that the company that are putting in, what kind of risk exposure are they sort of facing? What are the challenges that could actually affect the performance of the company? So some companies are having a higher barrier of entry, which prevented competitions. So they could be in a safer positions. So the other one is also we need to look at main revenue source of the company. Where are they coming from? Are they depending very much on the export market or the local markets? So if they are depending on the export markets, then they'll be subject to fluctuation in the foreign exchange. So, and also the operating costs. So what sort of costs are they incurring? Are they depending a lot on the foreign labor? Are they very labor intensive or automated? So what sort of proportion of these costs are from local or from imported. It could be the raw materials, could be from the overseas. Yeah. So the other major areas that we will be looking at will be the growth catalyst, with a prospective development that is revenue accreditable. So what is a driver we need to see in each company? Well, we need to look at the main driver of growth that is in the company. So it's important to understand the nature of the business so that in any changes in the macro economic developments, we can understand how it's going to affect the performance of the company. So the next things will be the profitability and growth factors. So the issues like sales, net profit, cash flow, profit margin, earning growth rate. In stock investment, earning growth is the most important factor that is affecting stock price. So in property, yeah, location. We always say location. Anything is about location. But in the stock market, in the stock investments, earning growth is the most important factor that is going to affect the stock price. So we need to understand the valuations. Yeah, from the analysis of financial statements, you come to a fair value. Yeah, it could be using various valuation approach as I mentioned before, as mostly practiced by the local analysts. So from there, you can have an idea of the valuation of the company. And also, in reviewing the financial statements of the company, we look at the asset qualities, the receivables especially. Are they real or just a fake invoices that may not be able to collect? And also you look at inventory. Are they marketable or are they full of obsolete stuff? The NTA, the working capital. So we also want to know how highly geared is the company, how much borrowings are the companies having? Are they able to pay back the interest? Yeah, the cash flow. What is the cash flow that cover against the obligations? So in analyzing a company, it's important to note that the operating cash flow is sufficient, is good and sufficient to cover the interest or obligation. Okay. And of course, the last thing is the productivity. You look at the return on equity and return on asset. As a shareholders, we are very particular about the returns. So whether the companies can produce the adequate returns for our investments. So a sample of the financial evaluation checklist is shown in the slide for your easy reference to understand the business. Just how we have mentioned the nature of the business, outlook, the risk, and also the main revenue source contribution and the cost contribution and growth catalyst and whether it matched with the current team play. So, another samples of financial analysis tables as what we discussed. You can tabulate it in a table form. You can to measure, to track the performance of your stocks over time, as shown in the slides here. So you're comparing the last quarter with the previous quarter and last 4 quarters, the past 1 to 2 years results. Yeah. So the factors that we're looking at will be the profitability, liquidity, productivity, and also the valuation. Yeah. The asset qualities, the dynamic PE, reasonable price to book, and NTA. And last but not least is the broker's consensus on the target price. So this you can actually refer to the various reports and also the Bursa Marketplace. This is the website where it's maintained or powered by Standard & Poor's. It also has a collection of the broker's target price for you to. It is good with good understanding of the reason that cause losses in investment, that we can develop a better approach to trading and investment. To increase our chances to make money in the stock trading investment venture. So I hope you'll pay a little bit more attention to why people are losing money in stock investment and trading. One of the foremost reasons is that most people do not understand the stock market operations, what it means. They have no clues. They don't know how to look at the financial statements. They have no understanding of the companies. They buy stock because people tell them it's good. They base the decision, their decision of participating in the stocks based on rumors and tips. They're very emotional, yeah, and just eager to join in the bandwagon. In Chinese, we say "kiasu," right? So you don't want to miss the opportunity. When you hear so many people making money, especially this round when the rubber gloves stocks are rising so fast. Some of them is the sustainability of the earnings is quite questionable. You can see that many of them already rising more than 4 or 5 times uh, uh, of their previous performance because of the COVID pandemic. Yeah. But now you can hear that there are a lot of companies that are also jumping into the bandwagon to produce rubber glove. So very soon you'll see a glut in the market. Yeah. So the other part of the reason for the losses are that human beings we don't wish to face reality. We avoid being caught in the embarrassing situation of letting people know that we are losing money. So we're holding on to losses. We're not willing to cut to sort of square the position to create a loss. And a lot of times when they still have cash, we tend to averaging down too fast, hoping to bring down the cost of holding of the stocks. Bear in mind that there is always a reason why stock prices are coming down. We should check for any fundamental damages. It could just be caused by the bearish overall market sentiment, which affect the share price temporarily. All right. The second most important reason is that most people do not have a very clear objective for trading. Yeah. They could have been starting with speculative motive for short-term gain. Then later, when they found out that after they bought, when the share price started to fall, they changed to long-term holding since they are able to pick it up. Yeah, we're trying to avoid the loss position. So this is a typical scenario of a poor selection of stocks with risk and volatility not in sync with the risk of the tolerance of the capital. Yeah. So many a times the investment time horizon, the holding period, also not in sync with the nature of the capital. And a lot of times the capital they have could be just for temporarily, but they invested into slow but stable, profitable companies. But when they see other stocks are moving, yeah, or suddenly when they need the capital, they are forced in a situation to liquidate the position to get the capital, and the stock at a point in time may not be performing because of the markets, the timing factor. So a lot of times also we need to understand our temperament. Every one of us are different. Some of us can take risks, some cannot. Some are very quick-tempered or hot. Yeah, we want immediate returns. We can't wait. So if you are the type who cannot wait, then don't invest in stock that are slow moving. Yeah. So certain stocks really requires patience. All right. So the third reason is the no money management. What I mean is that most people are not allocating even distribution of money to the different stocks in their portfolio. Yeah, let's say for example they have 1 million and they are buying some 10 stocks. You know, so not every stocks are allocating 100,000. Some stocks that they like, or particularly the irony is that most of the time they like speculative stocks, and this kind of stock we put more money in it. So that resulted in uneven distribution of risk as well. Okay. So the last but not least is no disciplines. Many a times you hear that, oh, we have a plan, but if you don't follow your plan, yeah, you don't follow your trading rules, it's like no plan. So the most important factor of all to win is actually discipline. This happened to even the seasoned players, yeah, in the market. So if you always lose money in the market, I would like to share with you in the next slide, the systematic investment approach or processes and the preparation to improve your trading experience and to trade confidently in the stock market. This is the bull trader strategy in short, BTS. As I mentioned, this is a money-making approach. It's not the Korean singer teams. This is a systematic investment trading approach using both fundamental and technical analysis to win. Our objective is to make money. We are serious about this investment. We want to make money. So it's good if you can pay some attention to this. So BTS incorporating 4 simple steps to make money in the stock market. What are these? First, investment objectives. As I mentioned just now, that's one of the reasons why people lose money. They flip. Sometimes short term, sometimes long term. Say entering as a short term objective, then it switch to long term, then the stock's not performing. So that is tricky, yeah, because the criteria for short-term stocks and the criteria for investing in longer-term stocks are very different. Yeah, the risk exposures are very different. So it's important to be firm in what you want to achieve in stock investment. After you set objectives, you will know what kind of a risk that you are able to take. So from there, you have to find the stocks that are matching the risk appetites of your capital. All right. So that's why we call a favorite list or monitoring list. So from the monitoring list that you created, you look for entry. How to look for entry? Before you look for entry, you must set up your entry criteria. What kind of criteria the stock must meet before you go in? This requires a little bit of application of the technical analysis tools. Okay, I will share with you towards the last part of the discussion today. Right. Then after you bought positions, you have to monitor for exit. Again, there are rules. You have to create rules. So if you're short-term traders, your rules can be very different. Your exit rule can be very different from long-term investor because the short-terms you can be a scalper, you can be a swing trader, or you can even be a day trader. So you sort of getting yourself involved with many trades with a smaller margin to make profit. Sikit-sikit menjadi bukit. That's what we're saying. That every trades that you go in, you make a small profit. But over time, these small profits will balloon accumulated into a huge percentage of returns. Okay, let's look at the investment objectives. So there are 3 areas in setting these objectives that you have to consider. What percentage of return do you expect from stock investment? So most people say, or industry say that, high risk, high return, but many a times you may be involved with very high risk stocks, but the returns may not be good if you don't have a strategy to manage it well. And then how much risk can your capital take? So as I said just now, in the various categories of stocks, there are stocks where the volatility is very high. When you have high volatility, it means the risk is high. But the returns can be high as well if you know how to manage it. So what kind of risk can you take? What is your investment time horizon? Is it 1 month or 1 week or 5 years? There's a long time for you to see your portfolio to grow. Okay, so after setting your objectives, you have the idea of what kind of stocks you would like to have. Then You can find the collections of stock that meet your fundamental expectations. So normally when we talk about looking at the stock, selection of the stocks are very much triggered by the fundamentals as a base. All right. So you can take leads from research recommendations or newspapers recommendations by established stockbroking companies or established papers, those writers. Or best still, if you're more ambitious and eager to learn, you can learn to do your own filter. It can be on a daily basis or weekly basis, depends on your objective, whether you are a short-term traders or you're long-term investors. So many stockbroking companies now offers this softwares for you to select or filter stocks of high growth, high dividend, or return on equity. Yeah, you can look for all those kind of financial fundamental information to do your screening. So yeah, I personally also teach people how to use the brokers' free market data to establish a spreadsheet to run a daily filter for uptrending stocks. Okay, so that's what to buy. Okay, now after knowing what to buy, when to buy, so you have to look for a trigger, right? So that involves the creation of a few entry criteria. So it depends very much on whether you are long-term investors or you're short-term traders. So the entry criteria for long-term investors, normally we define value investing criteria for, we look for divergence in price and value. Yeah, basically. So if you're value investors, the best time to enter is when the price are being hammered down. Like situation like this, when there's a crisis happening, you know, this overall market sentiment is so weak and so poor that people just throw stocks without reasons. So if you are looking for value buy, that's the time where you have to be actively looking for opportunity to buy. That is if you are value investors or long-term investors. But what if you are short-term traders? So you follow uptrending stocks, stocks with winning chart patterns and momentum breakouts. So that's where it shows that at a point in time, there are a lot of people interested in the stocks. Yeah, so there are with the huge interest of buying in the market, the chances of the stock's price going up is definitely very high. So you are just looking for that opportunity to make short-term money. Then you should focus on this kind of stocks. Of course, you have to address the issues of how to buy. So how to buy means that if you have only 20,000, how many stocks are you going to buy? Yeah, to be efficient. So if you have 100,000, how many stocks are you going to buy? What kind of stocks are you going to buy? If you have 1 million and above, how many stocks you should have in your portfolio? Are you going to have 20, 50 stocks? No, my recommendation is the best if you are below 1 million portfolio, best is not more than 5 to 8 stocks. Okay, over diversification will reduce or weaken your rate of returns. And how are you going to buy? You're going to break buying into batches. Yeah, not in one shot, not in one day, not in one morning or in one trade. Yeah, so it depends. Okay. After you bought the positions, what are you going to do? You're looking for exit, right? You're going looking to sell to make a profit. Then you move on. So you can look for another opportunity to buy and to make another round of profits rather than sitting on in one stocks. So you have to set criteria for selling. So if you're long-term investors, the criteria can be very different from the short-term traders, as I mentioned. So long-term investors, when to sell. So you look for price breaking major supports. Major, we're talking about longer term trends, like 150 days, uh, moving averages, 60 days moving averages, and so forth. Or even 200 days moving average. When the price move down these moving averages, you have to sell. Yeah, especially in today's when the brokerage rate is so low, there's no reason for you to hold on to stock that are plummeting. Yeah, you can always buy back the stocks when they stabilize. And there's no need to be too loyal to the stocks. Our objective is to make money anyway. So if you're long-term investors, you also look for bad quarterly reports. As I mentioned, every a quarter, within 2 months after the closing of the quarter, the listed companies are required to announce their results. So you look for the release of the quarterly reports. Any negative corporate development or industry, or any new laws that may be affecting the continuous smooth performance of the operations of the business. So these are things you look for. But if a short-term traders, then things are more versatile. So you look for bearish reversal candlestick patterns. You look for stocks breaking down the trend line or chart patterns. You look for downtrending signals. Yeah, unfortunately, you can't short in Malaysia today. Otherwise, there'll be another approach. You look for those stocks that are coming down and then just short them. There's another way of making money through trading. All right. So after learning the BTS process, how to start trading or investing, the technical strategy to make money in stock investment and trading can be best summarized in just 6 words. Ride the bull, short the bear. I repeat, the technical strategy to make money in stock investment and trading can be best summarized in just 6 words. Ride the bull, short the bear. How to do it right? Let me go through with you briefly the 5 considerations for entry and exit of a stock's positions. Okay, smart investors, what do you do? For entry, look for bullish trending. Yeah, what is a bullish trending? So it's always represented with the expansion of the multiple moving averages, where the short-term moving average is riding higher than the longer term moving averages. And the stock could be in the second stage of the stock price cycle. All right. So you look for bullish candlestick chart patterns or other price chart patterns that follow the market traders, market or the trader sentiments as depicted by the daily and weekly candlestick chart. Then you look to enter the stocks with low risk entry. Yeah, that means buy at the beginning of the breakout. This is to buy insurance to cut loss in case you're wrong. So at least you're not buying at a high. It just break out, you chase. But if you're wrong, you just cut. Yeah. And any strong breakouts of a share price must be supported with a significant rise in volume. Yeah. So you look for the volume clues. And all this bullish sentiments must be confirmed by technical indicators. Some of them are like MACD and stochastic or RSI. So that's all. Yeah, the 5 technical consideration for exit. For entry, and for exit, it'll be just the reverse. Yeah, it's pretty easy. So the 5 technical consideration summarized in the slides here. You can see here. Yeah, that the candlesticks are rising. The moving averages, the short-term moving average is on top of the longer-term moving averages, and they're expanding. You know, that's the best time for entry. Yeah, consolidating and breakouts. Yeah, you can see. So when you talk about bullish trading, we're talking about the share price keep going higher, and creating a higher high and a higher low. Yeah, even at the low, it's higher than the previous day's price. So that is a bullish trading environment. Okay, so that is moving average and the candlesticks, and the low risk environment. You want to buy at the beginning of the breakup and not at the high. Yeah. So that will grant you better insurance cover lah, to cut loss. Yeah, as I mentioned just now. So this is a more complete technical chart template for reviewing stocks. All right, you can see that it's summarized here, the 5 technical considerations. And of course, we include some other indicators like ADX for the directions, the momentums, MACD, RSI, and stochastic. So you can see that they exhibit certain patterns when you drop down. You can see that there are signs to tell you that the market is ready to move. And there are signs to tell you that the market is hitting its peak and is exhibiting imminent pullbacks. The pullback may be temporary, may not be a very sharp, not like in this instance, it's very sharp. The pullback may be temporary and it still continue the uptrend. Okay, the best way to view a stock is in a multiple time frame. Many charting tools today, you can have a breakup into 2. One is short, one is long. Yeah, it can be in a multiple pair or between daily and weekly chart for swing traders, or as a daily and mini chart for the day trader. All right. So that's all about what we're going to discuss today. And before I close, I'd like to introduce my new books. All right. For those of you who may be interested to know more about stock investment, developing your own stock filter and trading strategy, you can contact Bull Traders Training Academy for more details. For your information, I've written 2 books so far on stock investment, which can be useful guides to newbies. Those of you who are new and those who have been losing money in the stock markets. Obviously, if you keep on losing money in the stock market, it shows that you have not actually mastered the important winning traits of a trader or investors. All right, my second book, How to Develop a Winning Trading Strategy. Yeah, this is a very detailed, practical step-by-step approach implementing the VTS trading rules. It shows you the 4 simple ways to start trading. You set up the investment objective to align with your risk appetite and learn to create a stock monitoring list or stock screening. Yeah, there's a chapter purposely sort of incorporated to teach you how to do the backup from the market data feed from the stockbrokers and perform your own daily filter. You can set your entry criteria, so there's some guideline how you can set your entry criteria, very detailed guidelines, and also your exit criteria. So with this, I would like to conclude today's discussion, and wishing you all success in your stock trading and investment journey. All the best, and thank you. Thank you again, the organizers, for the opportunity to share with you all. Thank you.